Great. Okay, so our final talk of the day is Zach Feinstein from Stevens Institute, and Zach is going to tell us all about pricing and hedging and other things. Take it away, Zach.
Thank you very much for the introduction. Thank you for the invitation to come give this talk. So this is joint work with Maxine Bitrich at SUNY Buffalo. I just want to give a little bit of background why we started looking at pricing and hedging liquidity tokens in AMMs to begin with, because this was a problem that was generated from industry. So I was having conversations with kind of friend of a friend who was investing in AMMs, and kind of after the Terra Luna collapse, they said, how do we actually hedge our positions in these DeFi applications? And coming from financial engineering, that's kind of the basic question that we usually look at. So we asked the question, what is the fair price and how do we hedge these instruments that exist? So to get into it, we started with kind of a motivating example. This slide, I think everyone in the room is kind of comfortable with at this point. So we're looking at DeFi. AMMs are a specific application in DeFi where we create a liquidity pool of assets that anyone is allowed to trade against. So all we're doing is we're balancing these reserves based on certain mathematical formulas. And key to this talk is we're going to be looking at the liquidity provision idea. So any individual can pool their resources into the AMM and earn fees from the trading activity. So our key goal here is to analyze the fair price of these liquidity tokens. So if I become a liquidity provider, what is the actual quote unquote fair price to this position? And once we have that, can we get something like an implied volatility from DeFi? What other properties can we get from providing liquidity? Which particularly we're going to be focused on the idea of hedging the risk of becoming a liquidity provider. So most AMMs, and I think actually Roger Lee is going to talk tomorrow about how pretty much every AMM is a constant function market maker. So you accept a trade so long as some function U of, I'm going to do two assets, X and Y, is invariant from that trade. So if delta X units are being sold, delta Y units of the second asset are being received, then we want this kind of utility indifference type of notion, that U of XY is equal to U of X plus delta X, Y minus delta Y. So we keep this indifference idea. And from this, we can get our marginal prices just from taking the derivative, the partial derivatives of this function. Here, I'm assuming that asset 2 is going to be our numeraire. Throughout this talk, I assume that that second asset, which I'll often denote by Y, is a stablecoin. So think about it as USDC and X as being Ethereum. So when someone becomes a liquidity provider, they're providing both X and Y in such a way that the price is invariant to that provision. So they're adding both delta X and delta Y to the AMM, and the price before and after this liquidity provision doesn't get affected. But they're not doing it from the good of their heart. When you deposit assets into the AMM, you're earning fees. So you own this LP or liquidity token, and every time someone trades, you're getting a proportional fractional fee. So on Uniswap, most pools have 1, 5, or 30 basis point fees. I think there are some that go up to 1% fees. But the majority of pools are 1, 5, or 30. We're going to just say it's a constant fraction gamma, greater than 0, less than 1. This is just pure value, so 1 would be 100% fee, obviously no one's going to trade against that pool. 0, you're earning no fees. So we're going to, throughout this talk, assume it's strictly greater than 0, less than 1, but towards the lower end. And if you look at the Uniswap smart contract, these fees are earned on the incoming asset. So whichever of the two assets, X or Y, that is being sold to the AMM is the one that you're collecting this fee from. That is somewhat an arbitrary choice. We're going to follow it throughout this talk, but we could similarly study what if we took the outgoing asset, what if we always collected from the numeraire assets we always collected in USDC, what if we really liked ETH, so we're always going to collect on the risky asset. All are possible choices, but for the purpose of this talk, we're going to focus on what is done in practice, which is the incoming asset. And we're going to focus on really how is the blockchain working. So these are smart contracts, they are on the blockchain, which means that these transactions are only processed at discrete times. So we have a discrete time model, and we're going to assume that these blocks are at fixed interblock times. So we have a fixed delta t, which is greater than 0. If we're looking at the Ethereum blockchain, that's 12 seconds. Most of the data that I will be using in this talk is from the Polygon blockchain, which Augustino very helpfully introduced in the last talk, which has a 2-second interblock time. Again, the reason I use Polygon came from industry where those that asked the question provided us with a lot of Polygon data. So we took it and said, great, we don't have to download our own data. So because we have these fixed times that the AMM is actually able to update, even if we have a continuous price process PT, the AMM is only realizing PI delta T. So we have this discrete update to our price process through time. So let's look at the constant product market maker. And at least personally, coming from kind of math finance, I'm so much more used to saying I have a log utility. It's the same exact invariant. So we have u of xy is log of x plus log of y, same exact thing as the constant product, x times y, both give you the same invariant. And this comes from, for instance, Uniswap v1, Uniswap v2. It is replicated in a number of other AMMs as well. And we can look at this either through the reserves, X and Y, in which case we can derive how many liquidity tokens have been minted, L, which is just the square root of the product, and what the marginal price is, which is just Y divided by X, again, using Y as our numeraire. Or if we know the liquidity and we know the price, we can derive what the reserves are. X is L divided by square root of P, Y is L times the square root of P. So we can say, what is the value held by the pool? The price times X plus Y. Or if we want to look at it in terms of liquidity and price, it's 2L square root of P. So once we kind of derive this, and this is not really much of a derivation at all, we said, why did someone need to ask us how to hedge this product? My price of one liquidity token is 2 square root of P. My delta is 1 over square root of P. Problem solved. We were able to report back to industry after 1 day and say, why couldn't you figure this out? But we then took it to the data and said, okay, we have a price, 2 square root of P. We have a delta, 1 over square root of P. What if we delta hedged the liquidity token? So let's look at June 2023. This is a Uniswap v3 pool, but we assume we invest over the entire price interval. So ultimately, it replicates the constant product market maker. Assume the risk-free rate, 5%. This pool had a fee rate of 5 basis points. In blue, we have the 2 square root of P for a single liquidity token. So the price during this interval ranged from about $1,650 to about $1,900 at its low and upper ends. Take the square root, multiply by 2, you get this blue curve, which has these nice jumps to it, so it's kind of as bad as possible. And then we delta hedged it. We just said, let's delta hedge at each block time. And we get this very nice black line, which at first glance looks like it's completely flat. We've hedged, there's nothing there. But if we zoom in, we actually have a nice upward trajectory. We've hedged out our risk. This is kind of really nice. We've hedged out our risk, but we're making a profit. And this holds, the risk-free rate of 5% was arbitrary. We went from 0% up to 50%. It's consistent. We get an arbitrage. Is this a huge arbitrage? No, we're making about 10 cents over the course of a month on an investment of $86, but it exists. So the fact that an arbitrage exists means these objects are not really being priced properly. Ultimately, what happens, if we go back, this value held in the pool, the 2 square root of p, is not including the fees that you're earning. So we're hedging out the risk of, the price movement, which is a super martingale. Once we have 2 square root of p is a super martingale. But then we're earning fees. So it is pushing us actually from the super martingale to a sub martingale situation. And this is discounted. So when we say the risk-free rate is 5%, we're discounting everything. So this is not just coming from earning a risk-free rate. So we found an arbitrage, and that means somehow this is not actually being priced properly. So let's go back and see what is the fair price if it's not 2 square root of p. If we have Uniswap is pricing this, they're saying, we'll sell it to you for 2 square root of p. We look at the data and say, you're selling it too cheaply. What should they be selling it for? So we have our constant product market maker. We have fees distributed based on the size of your contribution of liquidity. So all we need to do is look at a single liquidity token. L equals 1 for the rest of this talk. And we're going to go to the Black-Scholes world. So PT follows a geometric Brownian motion under a risk-neutral measure. So dP is P times RDT plus sigma dWt. And we're going to make a simplifying assumption that there is 1 transaction per block. So what that transaction does is it just captures whatever arbitrage there is between this geometric Brownian motion and whatever the AMM was priced. Yeah.
The hedge trade is happening on the same day.
So the delta hedging. So yeah, so we assumed that you could do this delta hedge kind of externally, but at the price of the AMM.
And what are the fees paid on that?
No fees. So the Black-Scholes world. So again, this 10 cents, it exists in theory. If you actually try to implement it in trade every 2 seconds, whatever trading fees will eat that arbitrage.
And that fictitious venue where I'm doing this trading, what is the microstructure there? It has the same pricing function as the AMM?
You're trading it at whatever price it is. So there's no price impacts on the delta hedge.
Okay, so there's sort of
Infinite liquidity.
Where it magically copies the price.
Yes. Yep.
Okay, but what is that?
It's Black-Scholes assumption. We're in the Black-Scholes world here.
I don't immediately see why there's any contradiction or whatever that there is an arbitrage because
Well, yeah. So if you're small, then you're going to have pretty low price impact on Binance. It depends on the size of your position. Here we're trading $80. Or if you
would not be trading at the exact same price.
Yes. So the bigger assumption here is we're really assuming that we're going to capture whatever arbitrage between multiple exchanges at every time, which that won't necessarily hold. But if you're a small player in this market, then the quote unquote infinite liquidity, I don't think is the bigger issue.
So what you've seen is maybe it would be he wants to price that premium that he observes, like the fee part. So maybe just abstracting from the rest and focusing on that thing and that goes through it. To the value to price it. I understand that.
Okay. So we're going to make the assumption that there's one transaction per block. So we're assuming that there's no noise traders that are trading on the AMM. It is just going to be kind of arbitrageurs and form traders. So in some sense, this is the worst case scenario for the liquidity providers, that they're always being arbitraged. They're not collecting any fees from noise traders. So if we look at the fees that we're earning, we have gamma hat, which is just to normalize things, it's gamma over 1 minus gamma. So it's the fees that we collect. Then we have the price times whatever is incoming if it's X. So if someone is selling Ethereum and collecting dollars, the incoming is X. And then we're going to convert that to dollars. Or if someone is buying Ethereum, the incoming is dollars or USDC. We're going to collect that. And we're collecting this gamma hat of whatever the incoming asset is, moving everything to the numeraire, moving everything to US dollars. So once we get this idea, we could think of depositing liquidity as buying a perpetual Bermudan option. We can close out this position at any block, so it's discrete block time, so we get the Bermudan. It continues indefinitely until you exercise, so that's the perpetual part, but it is path dependent. The fees are paid at each block, which depends on the path of the price process. And as I said before, we can look at what the price of this token is. It is 2 square root of P0 if you're buying it at time 0. So if we know what the cost is, what is the actual value of this? So what is V0 of P for price P? And we can think of this as a dynamic program. At each block, I can decide to stop, to quit, and collect 2 square root of P. Or I can continue, and I get discounted continuation value, where I get the expectation of the value at the next block, plus whatever fees I'm earning in that single block. And just to simplify things, put everything in terms of prices, we can just say F of P0 to P1 is, this is exactly the same thing we have written there for a single liquidity token, where we convert X to 1 over square root of P, Y to square root of P. So first thing we can do is we can find what is exactly that expected fees that we're earning. We're going to call that F bar. And it is, we're able to calculate it directly because we're in a log normal setting. It's 2 times 1 minus e to the minus 1/2 r plus sigma squared over 4 delta t times the square root of price divided by this gamma hat star, which is somewhat ugly, but positive value. And we have this in the closed form. And it will show up quite frequently. So I'm just going to say from now on, gamma hat star is some constant that depends on volatility. And we're going to take the onsets that we are either never going to want to invest or going to want to invest for perpetuity, that we'll never want to stop if we chose to invest. So if we invest for infinite time, we just sum up these expected fees, and we end up where the valuation of this is 2 gamma hat square root of p divided by gamma hat star. So our ansatz is that if gamma hat is greater than gamma hat star, we invest, and then we never quit. If it's less, we never want to invest. And we can verify this ansatz quite simply. If gamma hat is greater, then this v tilde is greater than 2 square root of p. On the other hand, if gamma hat is smaller, our continuation value is strictly less than 2 square root of p. So we had a guess, we verified it, so we have a valuation, which is if our fee rate is larger than this gamma hat star, we should invest as a liquidity provider and will earn more than 2 square root of p in the long run. If the fee rate is too low, then we should not. Which means we can think about, based on this valuation, what are our Greeks? And we're going to assume that our fee rate is large enough. Yeah.
Before you were saying that the trading happens from arbitrage reserves, but where are the arbitrage reserves?
So the arbitrageurs are exactly keeping the pi delta t following this geometric Brownian motion.
So what I was expecting is that somehow the fact that only arbitrage are trading is that actually happens in money whenever you're trading versus like.
Yes.
But then
So that is, yeah, so we have like on Binance, let's say Ethereum is following a geometric Brownian motion, and then the arbitrageurs are seeing that they can make an arbitrage between Binance and Uniswap. So they're going to adversely select you, they're going to pay a small fee to do that, and you're going to update your price to follow Binance.
somehow the loss. I mean,
Yeah.
the counterparty in this arbitrage trade, like where's that cost? Here, the bottom.
So it's ultimately what it's coming from is if you invested for just one time step. So you go from time 0 to time delta t, then in expectation that 2 square root of p is going down. That's where that arbitrage loss is coming from. And then you're earning a small amount of fee from that. And what we're finding is in expectation, if you invest long run, the fees are going to outweigh the losses that you would get from the arbitrage. You have essentially a mean reverting strategy, and we have a martingale. It's a diffusion, but it is still a martingale.
Sorry, it's a martingale or it's mean reverting?
The strategy, so if you're an AMM investor, you have a mean reverting strategy. You profit when the price reverts. So your strategy as an AMM investor is fundamentally a mean reverting strategy. And we have a martingale price process. So in expectation, it's not mean reverting. We have a diffusion process. But there's some aspects where do I expect things to be in the future is around where it is. High volatility, but around where it is. Yep. So if we have this valuation, gamma hat star is smaller than gamma hat. Our delta is still really easy. We can calculate that. Our gamma, similarly, very straightforward. Nothing too interesting there. But we can also look at our vega. And our vega is just kind of horrible. And this comes from the fact that the gamma hat star is a function of volatility. And what we find is we have positive vega for small enough volatility, negative vega for large enough volatility. So this is not just an investment in volatility. We have this interesting dependence on volatility. So if we look at our vega, or here we're looking at the value of the liquidity token as volatility changes, and we can see if volatility is sufficiently small, where our value is smaller, we're starting with p equals 1, our value is smaller than 2, so we shouldn't invest. As volatility increases, we ultimately get to a value of about 7 for volatility. I think this is around like 50 to 60% volatility. And then it's dropping from there until eventually volatility gets too high. And we have this point where, again, we drop below and we should not invest. Or if we look at the actual vega, we have positive vega for low volatility, and low kind of in quotes because it still goes pretty high, but negative vega if the volatility is sufficiently large. So from this plot, we can kind of see we have, in this case, 2 implied volatilities because we have 2 points where we're indifferent between investing and not investing. So we want to say, what is the volatility sigma I so that our valuation is equal to 2 square root of p, is equal to the price that is offered on the market by Uniswap, which same thing as saying, when is gamma hat star equal to gamma hat? And we have a couple of different cases that we need to consider. Notably, none of these cases depend on what the price is or on what the amount of liquidity in the market is. So ultimately, once we say gamma hat star equals gamma hat, this is something independent of the price level, independent of liquidity. We have a flat implied volatility surface. So if the risk-free rate is 0, then there will always exist a unique implied volatility. In fact, we have a strictly negative vega in the case of the risk-free rate is 0, so actually you are short volatility in that case. On the other hand, if the risk-free rate is greater than 0, we have the possibility that there does not exist an implied volatility, that there exists a unique implied volatility, or that there exists exactly 2 distinct implied volatilities. So the previous example, we saw those 2 distinct implied volatilities, but it's possible there's unique, and it's possible that there does not exist one. And we do have this delta T bar, which, while we do need to consider it in practice whenever we've looked at any examples, this is orders of magnitude longer than any blockchain. It's on the order of hours to days, as opposed to seconds for Polygon, Ethereum. Unichain is now on, I think, half a second. So just orders of magnitude different. So hand waving, we can ignore that delta T bar, but mathematically, we do need to consider it.
Sorry, so, I mean, V0P was the value of this perpetual
Bermudian option.
And why are you now saying that you're defining the sigma I such that the value of this perpetual Bermudian option is 2 square root p? Why is that the?
Because I can buy this perpetual Bermudian option from Uniswap for 2 square root price.
Oh, okay. I missed that.
Yeah. So the liquidity token, if I go to Uniswap and I'm doing Ethereum to USDC for the constant product market maker, it would be a cost of 2 square root of p for that one liquidity token. So this would be at the price so that it matches the market. So if we, using kind of the data from Polygon, delta t is 2 seconds, risk-free rate is 5%, and let's assume that we have a 1 basis point pool. So as I said, that delta t bar is 8.5 hours, orders of magnitude larger than our 2 seconds, so that doesn't matter. But we can find that there does not exist an implied volatility. So when we look at this, a risk-neutral investor should not deposit liquidity in this pool. If we consider instead gamma is 1.4116 basis points, you can see we reverse engineered this solution. We get a unique implied volatility. But if we're a risk-neutral investor, it's a bad idea to invest whenever, if I believe the volatility is not equal to this implied volatility. If it's equal, I'm indifferent. If it's not equal, I have this negative expectation. And if we go to the 5 basis point pool, now we have 2 implied volatilities. We could have 0.0644, so 6.4% volatility, or 310% volatility. And we really did see those in the previous plot where we had those 2 points where we crossed the value of 2, again, because we don't care what the price is. So if I'm an investor, if I'm a risk-neutral investor, and I know that the volatility is between these 2 implied volatilities, then the valuation is greater than 2 square root of p. So I should deposit liquidity. If it's outside of that range, then the value is smaller than 2 square root of p, and I should never deposit liquidity. So this is where, when we looked at that initial data, we had something where, since this is matching exactly the pool that we were looking at, the volatility must have fallen somewhere between 6.4% and 310% annualized volatility, which is a pretty wide range. So it seems quite natural that we would have some kind of arbitrage opportunity. So just looking at how these arbitrage opportunities exist, where we get the different implied volatilities. If we plot the fees on the x-axis versus the volatility on the y-axis, the shaded region is where you should invest. The white area is where you should not invest. And the outside of that curve is exactly the implied volatilities. So you can see to the left of this curve, where the fee rate is too low, you never invest, there's no implied volatility. At exactly that 1.41 basis point fees, we touch the curve, and we have a unique implied volatility. And when we go to 5 basis points, we cross through, and there's a wide range where there is some sort of arbitrage opportunity. We should invest if we believe the fee is somewhere in that range. So let's go back to our data. So we said, okay, we have 2 implied volatilities. What exactly does this mean? It doesn't depend on the data at all. It's just coming from exactly, once I know what delta t is, and I know what my risk-free rate is, and I know what the fee rate is, the implied volatility is predefined. So let's try to, instead of doing an implied volatility, use the data to calibrate volatility. So rather than saying, let's take the returns and just find the variance of our log returns, let's use the fees that we collected as well as our valuation formula to see if we can get a semi-historical calibrated volatility. So our continuation value is just based on the fact that 2 gamma square root of p divided by gamma hat star is equal to this discounted expectation, where we know exactly what the continuation value is. So we can say what this expectation is. expand things out, multiply things through. And ultimately, what we want to do is find the volatility so that our observed fees match this continuation. And much like with the implied volatility, there can exist at most two volatilities so that gamma hat is greater than gamma hat star, and this calibration formula is satisfied. So it is historical looking. We have to have some kind of look back period where we're using the fees on Uniswap to calibrate this volatility. But the idea is if the fees are really what's generating the value for this position, let's use that to try to calibrate the volatility directly. So let's go back to our original motivating example. We have the delta t is 2 seconds. We have fees are 5 basis points. Again, 5% annualized risk-free rate chosen arbitrarily. Our implied volatilities, as we just said, were 6.4% to 310%. And we actually get a unique calibrated volatility in this June month. It comes out at about 25.82% annualized, which when we plug that in, gamma hat divided by gamma hat star is roughly 3. So the value that as an investor that I should be paying is 6 square root of p instead of 2 square root of p. So let's counterfactually assume that Uniswap was selling this liquidity token for, it would be 6 point something square root of p instead of for 2 square root of p. And let's do the delta hedging based on that updated multiplier. So we normalize everything. So we're investing $1 as a liquidity provider. So we're getting a fraction of a liquidity token. And we get a different number in the black dash curve. That's exactly what we had at the very beginning of the talk, where we had the 2 square root of p, we delta hedged it, and we got this somewhat arbitrage. And now using this calibrated volatility and the updated price of 6 square root of p, instead we have this mostly flat delta hedge position. So again, it kind of going back, we said there was an arbitrage. Things seem to have been priced incorrectly. We now can go back and say, based on the fees that were collected in this month, if we updated the pricing, we actually do get what we would expect from fair valuation. And again, this is discounted price process. It's not perfect. You can see a couple of points where we have these kind of jumps in our delta hedging. But it's as a first pass, assuming that we had a constant volatility throughout this entire month, it seems to kind of pass the smell check. So I think I'm running a little bit quick. Essentially, what I want to, one thing that I want you to get out of this is we can think of AMM liquidity provision as a path-dependent option. In particular, if we're taking the blockchain part seriously, it's a Bermudan option, which means we can think about how to value this and particularly how to hedge it. Because there's been a lot of reports in years past about how many investors in AMMs kind of lose money by doing this. So if we kind of go back to the very beginning where we had that pretty wild swings in the value of this liquidity token in that single month, but then when we hedge it, that disappears. So if you can think about how do you actually hedge this position, you could make this a much more palatable investment for normal retail investors. So if we can hedge it, then we can actually make this a better investment. And interestingly, because the delta t, because the time length for the interblock time does matter, the choice of blockchain fundamentally alters the value of the AMM position. So choosing to work on Ethereum versus Polygon versus Unichain will fundamentally change how valuable this is for an investor. So to conclude, I want to just say we had this idea that the valuation doesn't seem to be correct from the idea of when we do this delta hedging, we did get some positive drift. But some of that comes from the fact that there is no dependence on the amount of liquidity in the market for what the value is. So if instead we wanted some kind of freely floating price where Uniswap is providing, quote unquote, a freely floating price of this liquidity token, there's two ways that you could do this. The somewhat naive way is to say, instead of x times y equals L squared, kind of the traditional constant product, we could say x times y equals some function, like L of L. And if we did that, our valuation would now become L prime square root of P over square root of L. So you can actually use this to say investors will choose to mint or burn liquidity tokens at this varying price. That has some issues with implementation because if Uniswap is offering it at 2 square root of P, why would you go somewhere else that's making you pay more? But alternatively, we could have a variable fee rate. We assume that the fees being charged were constant over time. So if instead the fee rate is decreasing in the amount of liquidity, we would get this updated to gamma hat of L square root of P divided by gamma hat star. So now again, we can get an implied volatility that depends on the amount of liquidity. So there is some market reaction. So this would be a way that you can now update and use the amount of liquidity in Uniswap to get an implied volatility. So thank you very much. The paper is on archive.